So I've got an article coming out tomorrow on the website, realinvestmentadvice.com. We'll have it out in the morning, talking about the next crisis. You know, we've talked on the show here about the impact of rising rates, and I was talking about that at the opening when we were talking about doing the market wrap, talking about the impact of rising rates and the impact on consumption and debt and other things that we have. It's very interesting when you go back and look. Whenever rates have spiked as sharply as they have, and really since the election, and these spikes generally happen over a 2 or 3 year period. There's only been 6 other periods in history where we've had a similar spike in rates, and every single time previous to this, it has led up to some type of crisis, going all the way back to 1970. Sure, this time could be totally different. Anything's possible. But there are some basic dynamics of kind of the laws of economics that are going to play against the idea that this time is different. One of the big catalysts that I'm looking at and saying that this is likely going to be the issue is pension funds. It's a $5 trillion problem in the U.S. It's a $40 trillion problem globally, and that's trillion with a T. That is going to have to be dealt with. And the problem, when you start talking about a $1 trillion problem, a $2 trillion problem, a $5 trillion problem, which is what basically the underfunded status of these pension funds are, there won't be an ability for the Federal Reserve to buy bonds fast enough to heal up that problem. Because what happens here is that when we have the next market opening, it begins to accelerate on itself as that gap to the downside begins to impact the problems of the underfunded status of pension funds. And then all of a sudden you get a run on pensions because we now have this massive wave of baby boomers that are within striking distance of retiring. And they go, you know what? I want to get my pension now because I can't afford to lose it. So you get what's called a run on the pensions. So the more that the market declines and the more that risk of loss or that sense of loss of pension funds begin to build, and the more negative rumors that you get about the quality and the health of pension funds, just like we just talked about last week, Kentucky pension funds are out, the pensionees are out protesting saying, hey, we want a bailout for our pension fund. Not to mention Illinois and a variety of other states that have grossly underfunded pensions to the function of where they're like 20 and 30% funded. When retirees, when pensionees become worried about their ability to get their pension, they're not going to sit idly by and go, well, we'll just see how it all works out. They're going to start making decisions to draw that pension. And that's what you call a run on a pension. When you get, because see, the way pension funds work is they have a pool of assets, and there's 3 levels of calculation on that pension. So the first is that you say, well, my pension fund is $100. My total pension fund's $100, and at $100, that at 7% growth every year, that's going to pay out. That 7% is going to pay out the pensionees X dollars a month for the rest of their lives, as long as they live. But based upon the current level of assets, at an estimated growth rate of 7 or 8%, then I'm underfunded by some small amount, but there's still enough there that I can meet the requirements as long as the claimants on the fund fall within a certain schedule. So as long as there's not a big bunch of people that show up all at once, I should still be able to meet obligations. But what nobody talks about is the actual funded level in terms of if you just strip down the fund to the bare quality of the assets itself and say, well, what's the value of the assets you own? You're talking about funds that are 30 and 20 and 30 and 40% actual value funded. And since they've never achieved their 7% rate of return every year that they promised their pensionees, it's a much bigger issue than people want to pay attention to. So the problem here is that when you have a market meltdown, and so far we've been very fortunate not to have that, but we have some reversals here that are occurring. For the last 9 years, markets have been going up because interest rates are extremely low, flat, zero. You had the Federal Reserve flooding the system with liquidity. You've had the ECB, you've had Bank of Japan and Bank of China flooding the system with liquidity. helping support asset prices and generate a push up in the assets themselves, the value of the assets. You've had very low rates of inflation, and now all that's reversing. So I just want you to think about one thing as we get ready to go to the break here. If the markets have been rising over the course of the last 9 years because of a lot of liquidity being put into the markets, we have zero rates of interest, we have extremely low levels of inflation. If those have been the main drivers of why asset prices have been going up, how do you make the argument that asset prices can keep going up if you're going to reverse every one of those drivers? If interest rates are going to go up and inflation is going up and liquidity is going down in terms of central bank support, if those are all being reversed, then how, if the drivers are now different, in fact, if the drivers are now the opposite of what they were when the markets were going up every single year, how do you make the case that asset prices can continue to rise if you're reversing the very catalysts and supports that were promoting those stock price rises previously?